Hello again, ladies and gentlemen. Welcome to another edition of Capital Concepts. I'm Jeff Schuler, the Director of Research here at Spiker Consulting in Deerfield Beach, Florida, with offices in Manhattan and in the financial district of Miami. I want to talk for a moment about how to analyze the trading in precious metals, or some of the, I don't want to call them mistakes that people are making, but some of the misconceptions. If you go to a charting service and you want to do some charts, or you're reading some of the charts that we provide from time to time to our investors and to our clients, it's important to understand exactly what it is that you're looking at. Most metal trades on what's called the secondary market or the off market. And those are done in very private, bank-to-bank transactions that are not reported. As a matter of fact, the brokers involved in that have to sign non-disclosure agreements for every transaction that's done, every contract that is put into place. Nobody talks about it, the numbers are not reported, period. And that's where most of the business is done. Outside of that, the rest of the marketplace, the bulk, is really done on a retail basis through either the New York Metals Exchange, the New York Mark, or the London Metals Exchange, the LBMA grouping, or out of Hong Kong, same with Asia. And those are done around spot prices. That's the little barometers that are used. And again, it's very difficult to assign volume to it. There's no agency out there that's really giving us reports on volume. The only place that you see volume, and when we use the charts, are when someone pulls up an ETF or a futures index. Like, for example, if you're trying to do a chart on palladium, and you put in, and we'll use charts, stockcharts.com is a good one. You put in the dollar sign and PALL, what you're pulling up is a futures index. And so if you're trying to get something out of it, the movement of the price is good. I mean, that's valid, and that makes sense. You can figure, if you're good at that, you can use that. If you're good at figuring out the different formations and where relative strength might be, or where strength is found. And I don't want to even say relative strength as far as the RSI goes, because it's a separate index, separate way of looking at things. But if you're trying to look at where strength is, where weakness is, buying and selling, things like that, the actual movement of the price pretty much goes along with what's going on in the rest of the world. So that's valid. But if you're trying to use something like the RSI, the relative strength indicator, it doesn't make sense, because all that's doing is taking, a big component of that is volume. So if there's volume on the futures market, then it's going to be part of this chart for the RSI. Which, if you're trading futures, makes sense, but if you're going into an investment and you're trying to use technical analysis to figure it out, it doesn't make sense. It's not part of the equation. So don't use it. Don't even look at it. It's not really that accurate. There have been months, actually, if you go to October, you'll see where the relative strength was over 70 and stayed over 70 for most of the month, yet the price of the metal still moved up precipitously. I think it went from about $290, $300 up about $40, $50 an ounce. Just a big move up that month, when technically it would have said it's overbought. Stochastics, fairly much about the same thing. The MACD, the moving average convergence divergence lines, which are two lines, and once it's like the black line crosses, whatever direction it crosses the red, that direction it's going to move. That's actually been pretty accurate. It's not a bad type of an indicator. Again, it goes along price movements. And if you keep volume out of it, not a terrible thing. The Bollinger Bands are, again, that's another indicator that a lot of people like to use. Again, it's a price tracking kind of an indicator. It's more of a backwards kind of looking thing. I don't put a tremendous amount of salt in it for this, but it's not a terrible thing. But if you're going to use statistical, if you're going to use, not statistical, if you're going to use technical analysis to determine when you're going to come in or not, and I'm guilty. I tend to do that a bit myself. I like fundamental analysis for the long term and to see where I want to be and how I want to be there. But I will use technical analysis to make the determination of when I want to get in and what the best opportunities are. But what I found, really, honestly, if I can get any weakness right now in gold and silver and palladium, I'm a buyer. I'm a buyer big time. I'll buy anyhow, even on strength, because right now it's a matter of need. It's almost a have to, but I'll do my bigger buying on any weakness. But what I've been finding is lately, any weakness, intraday weakness, the buyers are coming in, they're coming in heavy. So it's kind of tough. If you go and you're using silver, SLV, or you're using what we mentioned before, GLD, these are ETFs. These are exchange traded funds. And again, it's the volume is not a good indicator because, again, it has nothing to do with the volume of the actual trading of the metal itself, but of a paper representation of it. So throw the RSI out. Don't even worry about the RSI when you're looking at your charts and you're trying to figure this type of thing out. Now, I'm going to throw one other thing in there. You say, Jeff, if we can't use the RSI, which is usually a major component, well, let me tell you something. If it was that easy, everybody would do it, right? If it was just as easy as looking at a picture or making yourself a chart and saying, oh, look, this is this, and this, I'm going to be a buyer, everybody would do it. Someone would jump in front of you and will blow the whole thing. So you're not that smart, I'm not that smart, so let's not even go down that path. But what it can show us, and I think you want to take a look, or you want to take a little gander at the silver chart, because what you're going to see is a couple of areas. You're going to see it at 15, you're going to see it at 16, 17, and recently 18, where resistance has very significantly turned into support. Very significantly turned into support. You're going to see a little bit of that on gold. You can see gold especially at 1,025. You're going to see it up a little bit higher at 1,075. I haven't taken a look. I think you're going to also see it at 1,140. Where again, you're going to see a lot of this. And there are, I think the best thing and the most important thing to me right now for technical analysis and looking at the relative strength of a given metal, the resistance of a given metal, and support of a given metal is to show me or tell me or give me an indication, I think is the best way to put it, of is the metal in strong hands or is the metal in weak hands? And there's two ways, two things that happen. If you see something rise precipitously, at this point, when it gets around resistance, if it breaks through it, you got to see if it's going to make support there. Now, at this point, anybody that bought earlier, these are called weak hands. If these people are traders, say silver, palladium, these are weak hands. Gold buyers aren't looking for 10 or 20%. They're looking for 100 or 200%, so they're all strong hands. And I think we've been seeing that. But with silver and palladium, the ones that are more volatile, where we're looking to make more money on a short term, what we've been seeing is it gets up to levels of resistance, it breaks through it, but then instead of a big pullback, where you see, again, turnover from weak hands into what then are strong hands, and then moving up, these hands are strong until they become weak at a much higher price, what we've been seeing, interestingly enough, is something else. A movement up, and then this. Turnover. So instead of these strong hands waiting for the pullback, or as soon as they start seeing any intraday weakness, there's buying. That's what we've been seeing, and that is an extremely bullish indicator. An extremely bullish indicator. So come to our website, check it out. We've got a lot of that stuff there. Give us a call. We're more than happy to get you some of this information to you. But when you're using technical analysis on top of your fundamental analysis, make sure to understand what you're dealing with. These are not stocks. Precious metals deal differently. It's a different world. Commodities, physical commodities, are a different world. That's why people like us and people in the research department of Spiker look at things differently. And if you're going to get into this, or if you're going to need to do this, you've got to deal with people like us that know what we're doing in this field. And let's do our jobs. But understand it. That's what this is part of. So if you're using technical analysis, remember, RSI, the relative strength, makes no sense. Ladies and gentlemen, I hope this has helped. I hope you have an absolutely fantastic day until we have the opportunity and the privilege to speak with you again. May God bless you all.